Welcome back. My name's Chris Gosselin from Australian Fund Monitors. Today I'm talking to Simone Haslinger from East Coast Capital Management. Simone, welcome.
Thanks, Chris. Happy to be here.
Good. Nice to see you again. We've spoken to you on a number of occasions before when you released your State of Trend report, which obviously looks at not only the performance of your fund, but what's happening in the commodity area which you invest in. So give us an overview. What's been happening in the last quarter?
Sure. So this was a fantastic quarter, all about clear, sustained trends. Our ECCM Systematic Trend Fund returned about 12.5% this quarter, which outperformed the ASX 200 and traditional 60/40 portfolios. So that was really pleasing to see. And it was really all about, a number of commodity markets as well as tech-driven equity indices like the Nasdaq, Nikkei, and Taiwanese markets, but also precious metals, which has been very topical in the press at the moment. Gold, silver, and platinum were ways in which we express that trade. And also cattle markets, live cattle and feeder cattle continue to be a great trade for us this quarter. And it was great to see a really strong reversal of Q2, which had been a difficult quarter for trend following. But Q3 has been a phenomenal rebound and, a good example of how systematic strategies can thrive in volatile markets.
Yeah, so you mentioned a few of the markets that have gone right for you. And as you say, that comes off the back of a difficult second quarter, and all of a sudden those trends have come about. Were you able to capture multiple trends, or was it just focused on one or two?
No, absolutely. Multiple trends. So, the cattle is one that we've been talking about for the majority of 2025. It's been a strong market across both live and feeder cattle markets. Gold, everyone's been talking about gold, it feels, over the last several months and probably escalated over the last couple of weeks as it's pulled back again. But gold is a trade that we've been in for the better part of the last 2 years, actually. It's a trade we got into pretty early. And then that has expanded across precious metals into silver and platinum. So platinum was one that really sort of entered in the third quarter and performed very strongly. And then, notwithstanding the market jitters over the bulk of 2025, we've really enjoyed some strong trending markets across any of the technology-led equity indices across the world. So it was actually a really strong quarter in terms of the breadth of trend following over the last 3 months.
Is it unusual to have so many commodities trending strongly at the same time?
Look, not necessarily. What the whole point of way we trade across almost 100 international futures markets is to try to generate uncorrelated returns. And so, you don't always necessarily understand the macro factors that tie all of these things together, but what we do is respond to price data. And so when we see price action, and it could be for various different reasons, obviously, the things that are driving precious metals are not necessarily the same thematics that are driving technology sectors around the world. And obviously feeder cattle and live cattle are completely disconnected from all of those markets and driven by completely different factors like strong demand for beef and supply challenges in that market. So, it is really a function of being positioned to take advantage of whatever is actually occurring in markets more generally and sort of being poised to jump on a trend as and when it emerges.
And just to reinforce the fact, this is totally systematic. So there's no cognitive bias from the fund managers, from yourself or your colleagues. This is purely systematic.
Yeah, that's right. It's an entirely systematic approach to trading. Really, where discretion enters is in the sort of system design originally, and then in how we implement that across many different markets. So, portfolio selection, if you like. Others may trade trend following on a much smaller pool of assets in a global sense. We choose to trade over a very large pool of assets because we think if we can cast the net widely enough across many, many different markets, we'll be able to pick up some of those obscure trends that other people may not get access to. And cattle's a good example of that.
And does that give you greater diversification? Do you have limits on the amount you can have in any one market or any one commodity?
Yes, in the sense that we have a fixed amount that we will allocate to any particular trade as and when we take it. Not in the sense that we would have an overall limit as to, for example, how much exposure we may have to equities at any point in time. We're limited more by the fact that there's a certain number of equity instruments in our portfolio, and therefore in our investable universe that we can trade at a point in time. So that's when the portfolio design comes into play, more so than an overarching limit on any particular asset class at a particular point in time.
Well, as we can see from the charts that we're going to show, your performance has been consistent and good over a period of time, as has the risk factors. How do you see things changing going forward? Or are you just saying, hey, we're pretty good at what we do and we're going to continue just doing the same thing, no style drift?
Absolutely no style drift. So we very much intend to continue to do what we've been doing. We've got a 5 3/4 year track record now. And across that period, we've enjoyed a CAGR of over 13% per annum. We continue to believe in the power of trend following. We're fortunate to be in an industry that's been around for decades. And there's, of course, data on underlying markets that goes back, over a century or more. So, we're very confident that this is a style that we've seen in the data and we've, lived through our live track record. It's a style that continues to persist and take advantage in exploiting, what the academics call time series momentum. So, really, we are extremely high conviction in a style that seeks to exploit markets as and when they trend. And, I guess the way I like to talk about it is dynamic asset allocation. As and when capital flows into new markets, we're positioned to take advantage of that.
There's a lot of talk about at the moment regarding bubbles, whether it's a bubble in gold and precious metals, whether it's commodities or AI or technology. And there's no doubt at all that markets have been on a tear, equity markets in particular, and certain sections of the equity markets that have been on a tear for a long time. Do you see one of the benefits of the strategy diversification of that risk? I mean, precious metals, yes, gold's had a pullback over the last week or so. So is it time to either get off that trend, but is it also a question of saying, well, we're diversified and therefore if it is a bubble, then we're going to avoid that through diversification?
Yeah, so, the fascinating thing about trend following is we will enjoy bubbles as well. So, I don't disagree. It could well be that, certainly equity valuations feel incredibly full, and on pretty much any historic metric you can look at, they're pretty extended. Now, maybe there's been a fundamental shift in how markets are structured, and AI is completely changing the way we should think about equity market valuations in tech sector. But the beauty of trend following is that we will continue to enjoy that trend, whether it's a bubble or not, up until we hit our stop levels. And we'll do the same in precious metals. So it really takes that anxiety and stress out of the way that we trade. We know that we will trade systematically. We know that we've got really robust data that sits behind what we do, and we've seen it trade really well through various different market conditions over many, many decades. So we know that it's a style that is resilient to shifts in market regimes. So it may well be that we're in some bubbles in some of these asset classes, and that's okay. I think there's a lot of people who probably called an equity market bubble 6-12 months ago and probably regret not being part of the last, 6-12 months of upswing. So, what's great about this style is that we have rules that tell us how to approach those sorts of extensions in markets and also how to exit.
And just out of interest, are you still currently on the gold trend, or has this pullback been sufficient to pull you off that trend?
We're currently still in gold.
You're still there. Okay.
Yes, that's right. But no, absolutely, it has pulled back significantly, and it could well be that our stops get exercised, and that's okay. Over the last 2 years, we haven't necessarily held gold the entire time, but we've enjoyed the vast majority of that rally over the past 2 years.
And where do those stops lie? Is it a percentage from the most recent high, or how do you actually engineer that?
Yeah, it is all in relation to the price action. So as the price moves up, we will move our stops up with that, but we'll never ultimately execute an exit from that trade at the absolute high. We'll always give the trade a little bit of room to move in terms of our stop levels. And it is with respect to where the price action has been. So yeah, you're right. It is a function of the most recent price action.
So that comes back to that concept that when a trend starts, you miss out on the first part of the trend while you're waiting to see if that trend is confirmed. Equally, when the trend is ending, you're not going to get out at the top, but you'll get out somewhere close to the top once the trend changes.
Yes, that's exactly right. So it's not about picking the absolute best entry, and it's not about picking the absolute best exit. It's about enjoying the trend as it continues, and as our models tell us that in all likelihood there is a trend there. And equally, we will get signals that tell us to enter trades that ultimately don't end up being confirmed over time, and we exit. And ultimately, it's about having a system that allows you to let those winning trades run and to cut those losing trades really quickly. So risk management is inherent and embedded in everything we do.
Okay. Let the trend be your friend.
Indeed.
Simone, one of the big benefits, I guess, of your strategy and implementation is that it's not highly correlated to any one single market. You've got really good diversification. How do you manage that level of correlation, or do you just measure it after the event?
So look, we are very deliberate about our universe design. We have, had a lot of thought into skewing our portfolio to be roughly 40% exposed to commodities and having a much lower relative allocation to equities. Ultimately, we think about our product as being complementary to traditional portfolios. So we enjoy low correlation of our style. Our fund has a correlation of about 0.25 to the ASX 200 over our almost 6-year track record, and a slightly lower correlation of about 0.22 to an Australian 60/40 portfolio. So our product is very much designed to complement a traditional portfolio, recognising that most Australian investors will have some exposure to property, stocks, bonds, maybe some private credit, venture capital, private equity, these sorts of investments that tend to be more aligned to how the ASX 200 performs. We have a low correlation to that, and what the data tells us over a long period of time is that when equity markets falter, there are other things that will trend. There are other asset classes that will kind of make up extra ground. And so we've deliberately skewed our portfolio to those other global markets to try and give our investors some low correlated but positive expected returns alongside.
And presumably you can trade the short side as well. So you can trade a falling trend as well as a rising trend.
Yeah, absolutely. And so, absolutely we do when we can. And through time, what we tend to see is that the long trades tend to perform because the market tends to be inflationary over time. But certainly if you think about things like currencies and cross rates, it doesn't really make sense to kind of be stuck in a long only or a short only kind of configuration. Sure. So yeah, certainly we trade long and short and take advantage of different market conditions and different market regimes.
So the US dollar has been particularly weak over the past 6-9 months, well, since Trump came back. Have you been on that trade on the short side?
So we have been trading different cross rates. I can't say that there've been some standout trades to talk about in currencies of late. Certainly earlier in the year, there was some movement around, US dollar strength reversing. But over the last several months, not as much. Really, the standout trades have been much more in the commodities and equity space in the last quarter.
Simone, as always, really nice to speak to you. Good luck with the portfolio. Good luck continuing with it, and we look forward to speaking to you again next quarter.
Excellent. Thanks so much, Chris.